So here's a puzzle for you. Imagine a company, right? Their sales dip maybe 8%. You'd think, okay, trouble brewing. But with Himadri Special Chemical Ltd, it's completely the opposite. They're actually celebrating record profits. How does that happen? Today, we're going to take a deep dive into just that. We're looking at the Q1 FY26 financial results and, well, the incredibly ambitious strategic roadmap of Himadri. They're a global player in specialty chemicals. Our mission really is to unpack the story behind these numbers, these kind of paradoxical numbers. We want to explore the bold moves Himadri is making and understand what it all means, for their future and especially for the industries they serve, like the clean energy sector, which is just evolving so fast. We've dug into their official stuff, investor releases, financial statements, presentations for the quarter ending June 30, 2025. Okay, let's try and untangle this Q1 FY26 performance. Yeah, on the surface, you see that 8% dip in revenue compared to last year, but then boom, these really impressive jumps in profitability. What are the actual numbers telling us here?
Yes, it's quite a contrast. The numbers, they really paint the picture. For that quarter, ending June 30th, 2025, the consolidated revenue from operations was about 1,118 crore, which, yes, is an 8% decrease compared to Q1 last year. But, and this is key, their sales volume actually went up slightly by 1%.
1% up in volume.
Exactly, reaching 140,090 metric tons. So they sold a bit more stuff. But here's where it gets remarkable. Their EBITDA, for interest, tax, depreciation, and amortization, it surged up 25% year over year to Rs 235 crore.
25%. Wow.
Yeah, and they reported that as their highest ever quarterly EBITDA.
Highest ever. Okay.
And it doesn't stop there. Net profit after tax, Piot, that soared by an incredible 48% year over year, reaching roughly Rs 179 crore, also their highest ever quarterly PEAT.
48% jump in net profit with lower revenue.
Precisely. And their ROC, return on capital employed, which shows how well they're using their money, that stood at an impressive 32%. And that's excluding investments in ongoing projects, the capital work in progress. So the core business is really efficient.
32% ROCE. Okay.
And their net debt, pretty low. Just Rs 107 crore as of June 30th.
So, right. More product moved, less money coming in the door overall, but significantly more profit landing on the bottom line. It feels counterintuitive, doesn't it?
Yeah.
What's the secret sauce here? How are they pulling off this robust profitability when the top line took a hit? Is this sustainable, especially if, say, raw material prices swing back up?
That's the crucial question, isn't it? And the management commentary gives us some big clues. Mr. Anurag Chaudhary, the CMD and CEO, he pointed directly at it. He said the profit growth was, and I'm quoting loosely here, driven by our continued focus on high-value specialty products, operation efficiencies leading to improvement in yields, and strengthening of our waste heat recovery systems. So efficiency is definitely part of it.
Okay, efficiency, waste heat recovery, standard stuff, maybe.
Well, yes and no. He also clarified that while revenue was marginally impacted by the correction in raw material prices, the quarter still saw notable progress across strategic and operational fronts. This isn't just about tightening belts. It's a real strategic pivot. Think of it like this. Instead of just selling, say, basic carbon black, which is subject to big price swings, they're shifting more towards specialized versions, things that command higher prices because they do something specific, something valuable for the customer. High-value stuff.
Ah, so it's about what they're selling, not just how efficiently they make it, moving up the value chain.
Exactly. That gives them more pricing power. It makes their profits less vulnerable to those wild swings in raw material costs. It builds resilience into the business model.
That makes a lot of sense. So this shift, this focus on value and efficiency, does it clearly show up in their margins? Can we see it there?
Oh, absolutely. It's stark. Their operating margin jumped significantly. It went to over 21% in Q1 FY26, up from about 15.6% in Q1 FY25.
Big jump.
Huge jump. And similarly, the net profit margin went up to over 16% from around 10.3% in the same period last year. They also managed their finance costs well. There was a bit of a hit from foreign exchange losses and other expenses, but clearly the overall efficiency and value gains just powered through.
Right. So they've definitely figured out how to turn that efficiency into hard profit right now, which is great. But for a company looking ahead, like Himadri seems to be, the real question is, what are they doing with that financial strength? Where are they putting their money for future growth? What are the big bets?
And that strong cash flow, that solid profitability, it gives them the confidence, the platform to make those bets.
Yeah.
Their financial health looks really robust. Consolidated debt to equity ratio is just 0.22, very low leverage.
Very low, yeah.
Yeah. And their ability to cover debt payments is strong too. Debt service coverage ratio at 12.37. interest service coverage ratio at 17.17. Basically, they can easily handle their debt. Plus, they issued commercial papers, short-term debt for Rs 300 crore during the quarter, and they got the top rating, ICRA A1 plus DJUSA. That signals strong market confidence in their liquidity.
Okay, solid financial footing then. But yeah, back to the future investments. For you, the listener, this is where it gets really interesting, I think. It looks like Himadri's been making some pretty significant, pretty bold strategic moves. Can you walk us through those? What are they buying or investing in?
Certainly, and it ties back to what they call shifting gears towards high-value growth and diversification to drive business resilience. That's straight from their roadmap. They're putting serious capital, mainly from their own earnings, into 4 key areas. It's quite an expansion.
4 areas, okay. What are they?
First up, Burla Tires. They actually started operations in Q1 this fiscal year, under Himadri's control, with a whole new brand identity and marketing push. Himadri sees this fitting strategically with their EV focus. They call it a turnaround opportunity, with high-value opportunities in specialized tire segments, off-highway, commercial, agri, industrial, and importantly, EV tires.
Tires. Okay, seems a bit different from chemicals.
It does initially, but they're also commissioning a specific passenger car radial tire unit just for EVs and SUVs. And remember, tires use carbon black, one of their core products. This cost about Rs 306 crore.
Ah, okay, the synergy makes sense. What's next?
Second is Sakona Battery Technologies. They've taken about a 15% equity stake, investing around Rs 84 crore. This isn't just money, it's an exclusive tech licensing deal. They get to make and sell Sakona's special 6-silicon carbon anode technology right here in India.
Silicon carbon anode. What's the big deal there?
Well, the anode is, the negative part of the battery. Sakona's tech, using silicon carbon, apparently boosts energy density, how much power you can pack in, by up to 20%. And it could improve charging speed by maybe 40%. Think longer-range EVs that charge way faster. That's the potential.
Wow, okay, 20% more range, 40% faster charging. That's game-changing if it works at scale.
Exactly. And Sakona's pilot plant is already apparently exceeding its production targets for the latest generation material. So it seems promising.
Okay, that's 2. What else?
Third, they invested in the International Battery Company, or IBC, about USD 4.4 million, which is roughly Rs 37 crore, for a 16.24% stake. IBC makes prismatic Li-ion cells, those rectangular ones. They already have a 50 milliwatt facility running in South Korea, but crucially, they're building a gigafactory in Bengaluru, here in India, scheduled to start up by Q4 FY26.
A gigafactory in India, okay.
Right. So this partnership gives Himadri access to IBC's manufacturing know-how, their customer base, and importantly, a ready place to start using Himadri's own battery materials, their LFP cathode and anode materials commercially.
So they get the tech from Sakona and the manufacturing capability or partnership via IBC. It's fitting together.
Precisely. And the fourth piece is Himadri Creations. They acquired a 40% stake for about Rs 45 crore. Himadri is deep into R&D, engineering materials for Li-ion electrodes, using nanotechnology, biosciences. They hold several patents.
So pure R&D focus there.
Seems like it. Advanced materials R&D. And what's fascinating, like you said, is how these pieces fit together. Tires linked to EVs and carbon black. Sakona brings cutting-edge anode tech. IBC provides cell manufacturing scale. Himadri boosts the materials science R&D. It's not just random investments. It's like they're building an integrated ecosystem, reducing reliance on others, potentially speeding up their path into the battery market. It all aligns with their vision of being a leader in clean tech and energy materials.
Yeah, that's a really comprehensive strategy, building out the whole value chain almost. So it sounds like R&D and innovation are absolutely central to Himadri. How are these partnerships and their own R&D actually translating into new products hitting the market? What new dishes are coming out of the Himadri kitchen?
Well, their R&D setup is pretty serious. ABL-accredited facilities, global teams, a structured 7-step process. And yeah, it's leading to tangible results.
Right.
Take specialty carbon black. They're doing a brownfield expansion, basically expanding an existing site. CapEx is around Rs 220 crore. It's set to be operational by Q3 FY26, so fairly soon. And this will more than double their specialty carbon black capacity to 130,000 metric tons per annum.
Double it. That's huge.
It'll make it the world's largest single-site capacity for specialty carbon black. And they're not just making more, they're making new types. They've launched 8 new specialty black series with over 60 different grades, including specific ones, the Li Plus and LB series, designed precisely for battery applications.
Ah, feeding directly into that battery strategy.
Yeah. Exactly, and catering to other high-end uses too. Synthetic fibers, performance plastics, conductive polymers, things like that.
Okay, what else besides carbon black?
Then there are other specialty chemicals. They're investing Rs-120 core in a new facility, expected by Q2 FY27, to extract things like anthraquinone and carbazole from their existing coal tar distillates. These are high-value chemicals. And apparently, this will be the first plant of its kind in India at this scale. The goal is to replace imports, make India self-reliant for these specific chemicals.
Reducing import dependency, always a good angle in India.
Definitely. And then something quite different. They're jumping into the B2C market business to consumer. They've launched DuraFresh TM, a brand of refined naphthalene balls. Mothballs, basically.
Mothballs, from specialty chemicals to mothballs.
Well, it's about capturing more value from their existing production chain. Naphthalene is something they make. The global market for naphthalene mothballs is actually projected to hit over USD 2 billion by 2033.
2 billion for mothballs.
Okay, yeah. And Asia-Pacific, including India, is the fastest-growing region. Himadri's angle is quality. They're boasting 99.5% purity, which they say is industry-leading.
Okay. Capturing value downstream. Makes sense. Anything else on the product front?
One more thing, liquid coal tar pitch. They made their first export shipment back in October 2024. This opens up the door to the large global market for liquid pitch, another expansion avenue.
Right. So expanding capacity in core areas, moving into higher value chemicals, even dipping into consumer goods and opening new export markets. Busy times. But going back to the big theme, the batteries. Given all these investments, the new products, it really feels like lithium-ion batteries are the cornerstone of their future growth plan. Is that a fair assessment? What's the grand vision there?
Oh, absolutely spot on. This battery materials segment, it really underscores their long-term direction. You have to understand, the anode and cathode materials, together they make up almost 65% of the cost of a lithium-ion cell.
65%. So controlling those materials is critical.
It's absolutely critical. And Himadri's vision here is, well, massive. They aim to produce 200,000 metric tons per annum of LFP cathode active material.
200,000 tons.
Yeah. LFP is lithium iron phosphate. It's a popular choice for cathodes, known for safety and longevity. That 200,000 tons capacity would be enough to cater to about 100 gigawatt of Li-ion battery demand.
100 gigawatt hours. That's a lot of batteries.
It's huge. They plan to do this in phases over the next 5-6 years. And here's the kicker. This will apparently be the first commercial plant for LFP cathode active material globally outside of China.
Really? First one outside China?
That's what they're stating. A pioneering step for India's self-reliance at Medhavar Farits. In action, you could say. The first phase, 40,000 tons capacity, is targeted to be operational by Q3 FY 2027.
Okay, that LFP plant is a major milestone to watch. What about the other side of the battery, the anode?
Right, the anode. Their existing product, coal tar pitch, is actually a key raw material for anodes. They're leveraging that base, plus the Sakona partnership we discussed, to develop various types: natural graphite, synthetic graphite, hybrid, and those advanced silicon anode materials, targeting multiple battery applications.
And the market demand justifies this scale of investment.
The projections are staggering. Global Li-ion battery demand is forecast to grow around 27% annually through 2030, reaching maybe 4,700 gigawatt.
4,700, wow.
Yeah. And India's own demand for battery energy storage systems, or ESS, is projected to shoot up from maybe 70 gigawatt in 2025 to potentially 1,700 gigawatt by 2030 in an optimistic scenario. Plus, you see EV adoption rising fast in India, already hit over 7% penetration in FY25. So the demand is definitely there, both domestically and globally. This really could position India, with companies like Himadri leading, as a trusted alternative in the global battery supply chain.
That's a massive opportunity for Himadri and for India. But, it brings up the environmental question. All these batteries, manufacturing them, disposing of them. How does Himadri square this huge push into batteries with sustainability, especially being in the clean energy space?
That's another really interesting part of their strategy, actually. They're focused on circularity, on closing the loop. Think about recycling. The number of used EV batteries available for recycling globally is expected to jump by 25% every year until 2040. It's going to be a huge stream of material.
A mountain of old batteries, yeah.
Exactly. And Himadri wants to be a major player in Li-ion battery recycling here in India. They were actually the only Indian company picked for a big battery recycling initiative with the Indo-German Science and Technology Center.
Okay, so they're actively involved in finding recycling solutions.
Yes. And the benefits are clear. Recycling reduces the need for mining new minerals, lithium, cobalt, nickel, all that stuff.
Yeah.
And it significantly cuts the carbon footprint. Using recycled materials to make new cells generates much lower CO2 equivalent emissions compared to using virgin materials. So it ties directly back to the clean aspect of clean energy.
Right. Closing the loop makes the whole system greener. So beyond recycling, it's clear Himadri talks a lot about growth and innovation. But how deep does their commitment to ESG, environmental, social governance actually run? Is it just, ticking boxes, or is it genuinely embedded in how they operate?
Well, based on their disclosures and the recognition they're getting, it seems pretty deeply embedded. And frankly, ESG performance is becoming strategically important now. They achieved the EcoVadis Platinum Medal. That puts them in the top 1% globally out of over 130,000 companies assessed for sustainability. That's a huge validation.
Top 1% worldwide. Okay, that's serious.
Yeah. They also got a B rating from CDP, that's the Carbon Disclosure Project, in their first evaluation in 2024 for both climate change and water security. A B is considered quite good, especially for a first-timer in complex areas. They've also signed up to the United Nations Global Compact, UNGC, directly, and got an ESG rating of 80 from ICRA, which is categorized as exceptional.
So lots of external validation.
Right. And these aren't just for show. Good ESG scores attract investors, especially big institutional ones focused on sustainability. It can lower borrowing costs, too. Internally, for FY25, they reported hitting some key targets. 100% zero liquid discharge status, meaning no liquid waste leaves their plants. They reduced energy intensity by over 17%, cut their Scope 1 and 2 carbon emission intensity by over 36%, and they maintained over 95% use of non-virgin raw materials, which links back to that circularity idea.
Impressive operational metrics on sustainability.
They also have safety targets, like their Vision Zero accident goal. And they've won a bunch of awards recently. Sustainability Leader of the Year, Energy Efficiency Awards, a Golden Peacock for health and safety, even top ranks in reporting awards like the LACP Spotlight Awards.
Okay, it sounds like ESG isn't just a sideshow. It's integrated into operations and strategy, potentially giving them a competitive edge, especially in the clean energy space where these things matter a lot. So let's pull it all together. We've seen the surprising Q1 results, lower revenue, record profits. We've looked at the efficiency gains, the shift to high-value products. We've dug into their bold strategic moves, tires, battery tech, cell manufacturing, R&D partnerships, and their strong ESG credentials. What does this all paint for their overall financial health and their long-term outlook? It sounds like they've mapped out a pretty clear path forward, haven't they?
They absolutely seem to have. The current financial health, as we saw, is robust. Strong cash flows, high liquidity, low debt, efficient capital use. Their network is solid, around Rs 3,647 crore. They had a net positive cash balance of over Rs 370 crore at the end of the last fiscal year, March 31st, 2025. Cash profit for FY25 grew over 35% to Rs 715 crore. And they're planning to spend big about Rs 1,450 crore in CapEx to fuel these growth plans. That shows real confidence.
Spending money to make money, basically.
Exactly. And their roadmap, what they call Himadri Reloaded, the next chapter running to 2028, it lays out the milestones quite clearly. FY26, this current year, focus on getting that specialty carbon black expansion done, starting up and ramping up Burla tires and launching the DuraFresh TM mothballs.
Okay.
Then FY27, getting a full year's benefit from the carbon black expansion, continuing the Burla tires ramp up, getting that anthraquinone and carbazole plant online, and crucially hitting that milestone of making the Phase 1 LFP cathode plant operational by Q3.
That LFT plant, again, clearly pivotal.
Absolutely. And then by FY28, the plan is to have all these new ventures running at full steam, really cementing that shift towards a high-value product portfolio.
So it's a phased, integrated strategy unfolding over the next few years, not just one big bang, but a series of calculated steps. What key milestones should we, as people try and understand this, keep an eye on as Himadri continues this transformation journey?
Definitely watch the commissioning dates for those big projects, the special carbon black expansion, Q3 FY26, the anthraquinone carbazole plant, Q2 FY27, and especially that Phase 1 LFP cathode plant, Q3 FY27. Keep an eye on the progress at Burla Tires. Can they successfully turn it around and integrate it? And watch for news on the Sakona technology deployment and the IBC Gigafactory progress. And, of course, tracking those margins. Can they sustain or even improve those impressive profitability levels as these new ventures come online and as raw material prices potentially fluctuate again? That'll be the ongoing test.
Right. So, our deep dive into Himadri Speciality Chemical Ltd. Really reveals a company that's quite strategically navigating market shifts. They're boldly investing in these high growth, high value areas, batteries, specialty chemicals, and they seem to be doing it with a genuinely strong commitment to sustainability woven in. It's quite a story unfolding, and it leaves you with something to think about, doesn't it? Himadri's story really challenges us to look beyond just the headline revenue number. Their strategic shift, focusing intensely on high-value products combined with, real operational skill, allowed them to turn what looked like a dip into record-breaking profit. So here's the provocative thought. In a world where commodity prices seem increasingly volatile, are companies like Himadri showing us the way? Is true resilience found not just in selling more stuff, but in deeply understanding and strategically dominating specific high margin value chains? Maybe volume isn't king anymore, maybe value is. We definitely encourage you to keep exploring this fascinating interplay you see between financial results, smart strategic innovation, and increasingly sustainable practices out there in the corporate world.